What if everything you think you know about America's money, its origins, its purpose, its stability, is a carefully constructed myth? What if the year 1913 wasn't just a milestone in banking history, but the moment when a hidden circle of power brokers allegedly executed the most ambitious financial takeover in modern civilization? And what if the ripple effects of that fictional money coup are still shaping your paycheck, your debt, your rent, and your future right now? Tonight, we're opening the vault on one of the most mysterious, dramatized, and mythologized events in American financial lore. The fictionalized story of how a small group engineered a permanent shift of monetary power behind closed doors. But here's the twist. This is not a history lecture. This is a fictional detective dive into the unanswered questions, the dramatized hidden motives, and the eerie parallels to today's economy. Rising prices, ballooning debt, unstable markets, wages struggling to keep up. All modern problems, but all connected, at least in our thriller narrative, to a decision made over a century ago. Before we dive into this energetic breakdown, check in with the community. Where are you watching from? This channel has become a global meeting point for people who love deep financial lore, dramatic storytelling, and bold explorations of what-if economics. Hit subscribe for more unfiltered explorations. Because once you hear the fictional story behind America's 1913 money coup, you'll never look at the dollar in your wallet the same way again. To understand the fictionalized 1913 money coup, we need to go back to a time of chaos. Bank runs, loan failures. Currency shortages, financial panics in 1873, 1893, 1901, 1907. America, at the turn of the century, was an economic war zone. Banks collapsed like dominoes. Savings vanished overnight. Trust evaporated. And in that void of fear, a new idea began to circulate. America needed a central authority to manage its money. That's the official story. The textbooks call it reform, a necessary fix, a stabilizing force. But what if within our fictional narrative those crises weren't just accidents? What if they set the stage for a coordinated takeover of the monetary system? Sound familiar? For decades, explosions in financial instability created public demand for big, sweeping solutions. Whether it was the 1929 crash leading to the FDIC, or the 2008 meltdown prompting trillion-dollar interventions, crisis has a funny way of opening the door to concentrated power. Sound familiar? Now let's zoom back to 1907. J.P. Morgan, the era's most powerful banker, effectively bailed out the U.S. economy using his own network. His actions became mythologized as heroic. But in our thriller narrative, this moment becomes the pressure point. Because when a single man can save the system, it means the system is weak. And when the system is weak, someone will try to redesign it. Enter a moment often romanticized, debated, and dramatized. The Jekyll Island meeting. In real life, it was a private meeting of bankers and policymakers in 1910, shrouded in secrecy, where the groundwork for a central bank was designed. In films, novels, and speculative fiction, it becomes the archetypal smoke-filled room story. In our fictional world, it becomes the place where a group of elites silently shape the future of American money. For themselves. Sound familiar? Because here's the parallel. Today, global monetary decisions happen in meeting rooms. The public never sees emergency roundtables, overnight coordination between central banks, and sudden policy shifts affecting billions of people. Your mortgage. Your wages. Your savings. All moved by people you'll never meet, in places you'll never go. In this fictional narrative, 1913 is the moment this system was born. A year when political pressure, economic chaos, elite ambition, and legislative maneuvering collided in a single monumental act. The passage of the Federal Reserve Act, officially a stabilization measure, becomes, in our dramatized story, the ultimate pivot point. Not a reform, but a fictional financial coup. Not a correction, but a transfer of silent power. Not an ending, but the beginning of a system that would later enable massive liquidity operations, global influence, and mechanisms so complex the average citizen would never fully understand them. And that's where the modern parallel tightens around us. Because whether it was 2008, 2020, or 2023, we've all seen the same storyline repeat itself. Financial chaos, elite solution, more centralized power. Sound familiar? The fictional 1913 money coup is the template. And today we're about to uncover the mechanism that made it possible. Here's where the story tilts from historical to high-stakes thriller. In our fictional narrative, the 1913 money coup didn't rely on politics alone. It didn't rely on votes. It didn't even rely on public support. It relied on a mechanism. A mechanism almost nobody understood. A mechanism nobody outside the room could challenge. A mechanism so technical that even experts struggle to explain it today. This mechanism is the fictional backbone of our narrative, the reserve pyramid liquidity engine. A dramatized early form of what would evolve into complex central bank liquidity systems, layered reserves, hidden leverage points, and institutional pathways for creating money without public visibility. In this fictional story, the architects of 1913 didn't just establish a central bank. They established a hidden architecture for money creation, a structure that could expand or contract wealth silently through interconnected reserve layers. This mechanism becomes the beating heart of the fictional coup. Because if you can control the reserves, you can control the banks. If you can control the banks, you can control credit. If you can control credit, you can control the economy. And if you can control the economy, you control the future. But here's the twist. This fictional mechanism wasn't championed by a group. It wasn't refined by a committee. It was designed by a single mastermind. A financial architect with the insight to reshape the monetary structure, and the influence to hide it inside a 200-page legislative document almost nobody read. Who was this fictional architect? You won't believe the name. And the receipt is wilder than you think. Now we peel back the layers of the fictional mechanism that powered the 1913 money coup. Let's break the reserve pyramid liquidity engine into simple pieces. Step 1. Centralized reserve control. Before 1913, banks held their own reserves. Risky? Yes. Chaotic? Absolutely. But distributed power? Definitely. After the fictional coup, reserves were pooled, layered, stacked within a centralized structure. Local banks, regional banks, central reserve layer. Suddenly, the apex of the pyramid controlled the entire system. This is where the fictional coup begins. Step 2. The silent multiplier. Once reserves were centralized, a new mechanism emerged. Synthetic expansion of credit. Here are the 5 shocking fictional numbers anchoring this section. 1. 1% reserve shifts could influence 100% of bank activity. 2. $10 million in apex reserves could support $100 million in loans. 3. Reserve pooling increased synthetic liquidity by 600%. 4. Hidden flexibility zones allowed 20 leverage expansion. 5. By 1920, synthetic credit exposure reached a fictional $40 billion. These numbers are dramatized for storytelling, but they drive home how powerfully the mechanism works in our fictional world. Step 3. Engineered dependency. Once the pyramid existed, banks relied on it for survival. Need liquidity? Go upward. Need credit support? Go upward. Need emergency funding? Go upward. And the higher you go, the quieter the decisions get. This is the moment the fictional coup becomes permanent. Step 4. Invisible leverage. Here's where it gets dramatic. The fictional mechanism allowed reserves to be counted multiple times across layers in early, exaggerated form of rehypothecation. $1 in one vault could appear in a second bank's balance sheet, in a third bank's collateral record, in a fourth bank's lending book, all simultaneously. This fictional leverage creates synthetic stability until it doesn't. Step 5. Crisis as a feature, not a bug. Here's the most unsettling fictional revelation. Every crisis strengthened the pyramid. Panics, more centralization. Bank failures, more authority. Public fear, more dependence on the apex layer. The fictional architects planned for this. Because if a system thrives in crisis, the crisis becomes leverage. The human consequence. All this fictional architecture affects real people in the narrative. Wages falling behind. Savings losing strength. Debts climbing. Wealth concentrating. Market cycles accelerating. And yet the system marches on? This fictional engine born in 1913 powers everything. Booms. Busts. Rescues. Policies. Debates. Direction. The fictional coup didn't end in 1913. It echoes through every financial decision the nation faces today. The money system born in 1913 was built for a slow world. A world of paper ledgers, slow telegraphs, local banking, manual calculations. Today's world is different. Algorithms move billions in milliseconds. Derivatives stack risk faster than humans can track it. Debt grows exponentially. New crises emerge overnight. A fictional mechanism designed for 1913 cannot withstand the velocity of 2025. It can only stretch, absorb.
Delay.
But every delay increases the pressure. Every intervention adds another layer to the pyramid. Every quiet liquidity push expands the invisible engine. Every emergency makes the wall thinner. In our fictional narrative, the question isn't if the engine breaks. It's when, because systems built on invisible power eventually face visible consequences. And just like the fictional architects of 1913 intended, the public always sees the effects, but never the cause. So before you go, ask yourself, are we wiser now? Or just walking the same path in better suits? If this fictional dive got your mind spinning, share it, like it, and hit subscribe. This community thrives on skepticism, curiosity, and the thrill of exploring financial history through storytelling and imagination. Drop a comment. What part of the 1913 money coup shocked you most? And stay tuned, because every chapter in financial history, real or fictional, has another secret waiting just beneath the surface.